Welcome back. We are back for another episode of Chart Overload. I'm Ryan Mumy, and with me is Mr. Justin Greenhill. Justin,
Good
always a
day.
pleasure. Even though we talk every day, I feel like we have to be a little bit official when we do these.
You got to be cordial.
Yeah, right. We're filming this on the 11th of March, so in the background is quite a bit of noise in the equity markets with the NASDAQ down over 12 and the S&P over 9 in the last 2 or 3 weeks, a little more than 3 weeks. So we think it's timely to do this chart overload, but let's go ahead and get started with our first visual here. Looking at the big picture is that, let's look at the focus. Some of the soft data as well as some of the hard data has rolled over a little bit.
Yeah. So the expression "a picture is worth 1,000 words." This pretty much says it. So very quickly, the market has shifted to expecting there to be a slowdown in demand. So you can see this top left, consumer sentiment index has rolled over. Top right, you can see month over month spending in the U.S. has also had a pretty big move lower. And then, interconnected and potentially a driver to that has been the fact that inflation, albeit down from the highs, prices have been sticky, and that's reflected there in the bottom two graphics. Long-term inflation expectations and a little uptick there in consumer prices year over year. So, and this whole thing that you mentioned in terms of drawdown, this really all kicked off with Walmart having a negative guidance right at 4 weeks ago, roughly on a Friday. So the market's been repricing ever since.
Yeah, and I mean, the more things change, the more they change, right? We've been in a nice run up for a long time, and this happens. Things that go up come down a little bit, and let's see how the landscape changes. And moving on is looking at a little deeper at that spending. It appears a much larger percentage of that spending's coming from a very small group.
Yeah, we find this chart to be particularly interesting in that when you look at so-called middle income and lower income households in the U.S., that really rolled over back in late 2023. And it's been, so-called high income that has flatlined of late, but has been increasingly resilient. And the reason we bring this up is high income spending is very much connected to sentiment around asset prices. So, if the stock market doesn't rebound back to new highs here in the near term, then we would expect this yellow line to come down a bit, if not a lot, because there is a pretty positive correlation, again, between asset prices and the spending habits of high-income households.
Statements up, spend a little more liberally. Statements down, tighten the belt a little bit.
That's right.
Next chart talks a little bit about the pricing in of slowdown between the not only the United States is looking at the all country world index, but also crude oil.
Yep. So, very classic two markets one could look at here and say, what are they telling us? And as of late, they're basically saying that the outlook for the economy, in particular on the demand side, has started to slow. So despite a bit of divergence early in the year, of late, we've seen both oil prices and all country world index stock market pretty much down at the same time. So, classic, let's call it deflationary demand pricing in the global markets of late.
Yeah, and we talked a little bit of this in our Monday commentary that, oil prices are getting hit with a couple different shots. One, OPEC surprise supply increase or commitment, I guess, would be a better descriptor of that. But also, demand data and governments looking to or projecting slowdowns in demand. So that's a double whammy to the black gold.
Yeah. As well as just kind of ongoing recomposition of the Chinese economy. There's also been some headlines sprinkled in there about a secular decline in oil demand from China. They've really electrified. So we shall see.
Moving on, the next one, the U.S. dollar, which we've talked about every chart overload, and most of them have been about its surprising strength. Well, cue sad trombone.
Womp womp.
Womp womp.
Yeah, that's changed pretty quickly. So it's important to keep in mind when you look at the dollar index, which is this chart that is, heavily weighted towards the euro and to a lesser extent Japanese yen and British pound. So think of it as, dominantly against the euro. But what's been interesting is that during this most recent sort of repricing in global assets and expectations for some economic weakness, the U.S. has been relatively weak in terms of, consensus is expecting it to roll over perhaps more than the rest of the world. You combine that outlook for lower relative growth compared to other parts of the world to the fact that, interest rates are interconnected and potentially moving even lower in the U.S. That's been enough to bring the dollar down pretty sharply, along with some, potentially bullish fiscal spending headlines coming out of Europe and some pro-business headlines out of China, which we'll get to in a later section.
Moving on to the next section. Great lead there, Justin. Let's talk about U.S. stocks. So first one, we talked about a little bit, I talked a little bit at the open. The NASDAQ has experienced a sharp drawdown,
to say the least. So
short order.
This has been the dominant driver of the market for some time. Think of the biggest growth-oriented companies. And what's interesting, in about 4 weeks, this index basically gave back, what is that, roughly 6 or 7 months of performance in 1 month. So classic, stair step up, escalator down, or elevator down type scenario.
Yeah, and for the first time in 2 years, it closed below its 200-day moving average, which, it was the second longest uptrend in the history of the NASDAQ. This uptrend that we just kind of are washing out here.
Yep, and exactly. And it's been the biggest winners into and post-election have been the biggest losers as well, which is a classic so-called momentum unwind.
Moving on, let's talk about what's been the major driver of a lot of those NASDAQ returns, the so-called Mag 7. They haven't fared very well since the beginning of the year.
No, this year they've been anything but magnificent. And as you can see in this chart, the black line, which is Tesla, since the beginning of the year, Tesla's down roughly 50%, which is a truly epic round trip. A couple months ago, we did one of these videos and we were showing the chart of Tesla flying high after.
Which one of these doesn't fit the bubbles?
Yeah. So if you bought Tesla at the beginning of the year based on some narrative and held it, you were down roughly 50%.
Oops. Moving on, active investment managers have gotten a little bullish.
Or a little less bullish, you should say.
Yeah.
Yeah. So this is a classic NNAIM survey, which, they've got their own methodology, but basically over a period of time, they're looking at exposure of active managers. So think mutual funds or think, non-systematic strategies, but strategies where people can be more or less exposed. They could raise cash. And this has rolled over a bit as well. So, people have become defensive relative to where they started the year.
And talking about those systematic strategies, this next chart looks at CTA positioning, and just like active managers have pulled back their bullishness a little bit, CTAs have really went the other way.
Oh yeah, and we actually think this is potentially more interesting than the active manager positioning, in that CTAs is a broad category, but generally speaking, they're going to be long assets when they're in a quantifiable uptrend or up momentum, and then they're going to sell and or be short when the opposite happens. And this has been a very quick deleveraging from CTAs, which has everything to do with the fact that, roughly 4 weeks ago, a lot of these trends, which you mentioned, Ryan, in regards to the 200-day, a lot more of the near-term trends, which these strategies go off of, they all broke very quickly.
They broke quickly. Next one, again, talking about systematic strategies. We're looking at the fall control funds. What does this show us, Justin?
Yeah, again, there's many different ways that you can measure this. So we pretty much tend to ignore any sort of analysis that will say some number of billions is going to buy or sell from the systematic community, because we don't find that to be very helpful, considering that there's a lot of art to coming up with that number. But this is actually very interesting in that this is really just a composure of what would be CTAs mentioned above, as well as what would be so-called vol targeting or volatility scaling strategies, of which some CTAs are that plus trend. And it simply means that if a trend or momentum is negative and or volatility is rising, this blue line is going to be further close to the bottom than it is the top. And you see this big sharp drop off from really the beginning of the year, and especially as of late. And what this ultimately tells us is, going back to roughly 2010, a composite sample of systematic strategies doing trend, momentum, and volatility targeting, they're extremely light compared to where they can be.
Yeah, and let's back up. Why do we talk about these institutional systematic strategies? Well, the answer is they control lots of money. And when they have a big pot of money, let's say $5 billion that they're managing with a specific systematic mandate, meaning rules-based, if this, then this, if this, then this, they're also trading it with immense leverage, where oftentimes it's 5 to 10, and in some instances, even more leverage. So on their $5 billion, they're trading 50 billion or more worth of securities. So it can really drive the markets. Now, we all like to, I wouldn't say we all, lots of people like to watch what we call entertainers, finance entertainers that smash buttons and scream and sweat into the TV. But those folks don't drive markets near as much as they would like you to think. And so that's why we constantly have knowledge of where these big institutional systematic strategies are moving. Not that we can know what they're doing, but based on history, we can have a good idea how they're positioned and what they're most likely to do next. And it just helps us with making determination on what's best to do for our clients.
That's a great point. And, in a case like this, when you've seen so-called systematic positioning drop so much, that doesn't necessarily in and of itself give us an action signal. But what it does say is that a lot of the selling from those participants has already happened. And in order for it to continue, it's going to have to, broaden out to an even wider type of participant, or it's going to have to actually pick up even more momentum to the downside. So that's kind of how we process that.
Our next chart relating to domestic equities is old equal weight. It's had a little run here recently after getting just beat up for a long time.
Yeah, so as we mentioned, a lot of the selling has been pretty disproportionate in what were the big momentum names. So we talked about the Magnificent Seven. This chart here is basically the equal weighted S&P 500 relative to the market cap weighted. So as you can see on the far right, equal weight has outperformed pretty substantially since the start of this sell-off. And now the ratio is back to where it was around the summertime of last year. So some of that separation between the biggest of big companies and all the rest has been equalized here of late on the downside.
Equalized. Yeah, and I mean, that's the question is, to your point, does it broaden out with the systematic strategies? It's not just to participants. It's does it broaden out to other securities that haven't had the big runs? The NASDAQ, what was it, up over 70% in this latest up move? Not all securities in the United States have had that kind of up move. Do those that haven't had the big up move, do they start participating as much as, say, the Mag 7 to the downside? That's where we could, to your point, see a broadening out or an extension of this wicked down move in equities.
Yeah, and just adding to that, another thing is that, there is futures contracts for the small cap Russell 2000, but generally speaking, a lot of these CTAs, they're going to trade off of the primary indices. So typically when they move, they're going to, move S&P 500 market cap as opposed to equal weight. So it will be important to see, do we stabilize here? And this has been kind of a rotation, or, do we have more momentum to the downside? To be determined.
TBD. Let's move on to our next section, non-U.S. stocks. First one, just talking about the relative performance of non-U.S. stocks versus U.S. equities here. It's been pretty wide in a short period of time.
So we mentioned it a little bit off the top, but two big headlines this year has been the emergence of, what is being promoted as a competitor in the AI space out of China, as well as the fact that Chinese leadership has now shifted tone once again and is meeting with the CEOs of their big tech companies, sending out the vibe, I guess you could say, that they are more friendly towards those companies. At the same time, after much pressure from the Trump administration, Germany has announced that they are going to do a truly massive fiscal stimulus and start paying for their own military. And the market took that as a very positive thing for ex-US equities at large. And as you can see here in this top chart, when those bars are downward, that is ex-US stocks outperforming US stocks. So last week was one of the biggest non-US equity relative outperformance weeks, in history, going back over 2 decades.
And moving on to the next one, continuing with that trend, is this dynamic of non-US stocks outperformance. It oftentimes will continue for the year when it happens like it did this year.
Yep, and all this shows is that, generally speaking, when U.S. stocks underperform non-U.S. stocks to start the year, typically U.S. stocks do not come back and dramatically outperform non-U.S. stocks for that calendar year. And one can think of this as that oftentimes new themes and new rotations in portfolios emerge to start the year, and then there is a momentum effect to that thereafter. We shall see, but if history is any evidence based on probability, we would expect this could be a year where non-U.S. outperforms.
And let's move on. Next section, interest rates and fixed income. We've seen some treasury yield retreat here to similar over the same time frame as the equities, but also since the beginning of the year.
So there's a few things to kind of take note here. I think the first is that bond yields have moved lower during the recent sell-off in the stock market, which is a very classic, the market's worried about a recession. But what you can see here in this chart, the black line, which is the 2-year treasury yield, and the red line, which is the 30-year treasury yield, short duration fixed income has actually moved down a bit further. And what this basically tells us is that if one were to really make a bet on there being a recession and the Fed needing to cut interest rates dramatically, there's some pretty significant relative value potentially on the longer end of the yield curve still yet. And, if these recent correlations hold, where bonds do well when stocks do poorly, we think there could hypothetically be a lot of money that rotates into longer duration treasuries as the year goes on.
Yeah, because the short end is being driven by expected Fed policy or actual Fed policy. And what's interesting is the market's pricing in the Fed's need to cut faster than they had been anticipating with this move on the black line, the 2-year, the short end. But then Powell came out and announced that, basically steady hand, we're going to watch the data. So again, there could be a reemergence of some volatility in the yield market, which has been fairly tame, even though they've been in a downtrend and bond prices are up. The volatility hasn't necessarily been that high, and we could see that because there appears to be a little mismatch at this time.
Yeah, that's a good point.
Moving on to the next one, let's look at the FinTwit's favorite thing to argue about from an employment standpoint, the SOM recession indicator.
So there's a very specific reason that we put this in the interest rate section as opposed to the equity section, in that, people will often look at these recession indicators and use this as a means to, bet for or against the stock market, but they're actually far more useful to be used in the interest rate market. So Ultimately, what this is saying is just that a 3-month moving average of the unemployment rate has risen by 50 basis points, a 0.5% or more, relative to the minimum of the 3-month average of the previous 12 months. So, long story short, jobless claims or unemployment is picking up. And historically, we don't want to use this as a means to have a directional view in anything in and of itself. But when this indicator is picking up, when, to your point, Ryan, interest rate volatility has come down and interest rates are starting to show negative correlation to stocks, and interest rate markets, treasury bonds are showing positive price trend, the weight of the evidence suggests that if you were to bet on bonds, they would have at least a positive expected return. So that's how we view that.
A long way to say that there could be an opportunity in long treasuries, but we don't know yet, right? Let's wait and see. It's really hard to make big moves during heightened volatility, right? It's better to wait for some smoothing out, to see if it's just a correction or it's truly a long-term trend change, and to be determined. I like what we say often, weight of the evidence. There's not one thing that says that's it, we need to do this. It's a constant weighting of the risks and the reward, because data changes all the time.
Well, that's a wonderful point. And just to add to that, oftentimes the weight of the evidence doesn't necessarily first suggest what you should do. The weight of the evidence might first suggest what you shouldn't do. And if you're looking at a prudent recession indicator, you're looking at price trend in treasuries, you're looking at correlation in treasuries, et cetera, then the first thing that would tell you to do is you probably don't want to bet against the treasury market right now. And then you deduce forward, that might mean you should want to be with it, right?
Yeah. So, moving on to the last section, let's talk about commodities. First one, oil and natural gas. They don't look normal.
Yeah. So
traditionally they run together.
Oftentimes, yeah. So you've got the blue line, which is WTI oil, the black line, which is natural gas. And what's happened recently, especially since, call it mid-January or so, has been oil has gone pretty much straight down and natural gas has continued to go up. So as we mentioned earlier, it's likely that oil is just being perceived as oversupplied, plus there is a slowdown in demand. Natural gas, on the other hand, has a lot of idiosyncratic factors that could be supporting that market. Additional demand for the power grid. There's also a pretty significant arbitrage opportunity where the U.S. natural gas can then be sold to either Europe or Japan, and there's increasing ways to do that. So, I don't think there's really anything actionable here, other than I think we could say that oil is often, in this instance, reflection of the demand in the economy and supply specifically in the oil market, versus natural gas is kind of walking to its own beat here, I guess you could say.
And finally, our last chart in chart overload, thank God, is talking about soft commodities. That they've found some speculation similar to the equity markets, the crypto market, and lots of other markets where tons of money is chasing things like a lottery ticket.
Yeah. So back to our comment about CTAs and strategies that follow trend. Soft commodities were a very strong corner, albeit a very small corner of the overall commodity market up until recently. And you take a look at this chart, the price of cocoa and the price of Bitcoin, it looks like the same thing. And ultimately what this tells us is that, market participants who follow trend do it across all assets. And you end up in moments in time when very unrelated markets end up moving in lockstep. And, back to kind of the theme that we talk about and track across markets, correlation, we want to be very careful in terms of assigning a fundamental narrative to, in this case, say cocoa, when in fact it is actually moving along with Bitcoin.
Very interesting. Well, that's it for this chart overload. We appreciate you tuning in again. I'm Ryan Mumy, and that's Mr. Justin Greenhill. We'll be back in a couple weeks with another episode. If you need anything from us, have any questions, please reach out to us at info@solinda.com, info@sollinda.com. And always remember, don't act on anything we do without talking to your pro first. But we appreciate it. Go on and have a great week. Thank you.